Hey everybody, Larry Berman here, and here's what's on my radar and should be on yours. The dot plot, the Fed update. Wow, I have not seen this much confusion and divergence in terms of policy expectations, and we can see it in so many different areas. So let's have a look into the chart room. The summary of economic projections, known as the dot plots, was updated this week. So every quarter, at every other Fed meeting, they update their projections. And what we saw this time relative to last time. So we can have a look here and say, okay, this is March. There's the current numbers, but this is what we were looking at the December meeting. So the expectations for at the December meeting for where the terminal rate would be, and the consensus around that was just a little bit over 5%. And when we look into the end of 24 and 25, you could see that we were at a little over 4 and then a little over 3 in terms of where the median plot was. The curves here are the overnight interest rate swap curves, and those are the current implied for the market. So, where we were, the dispersion from the extreme bear to the extreme bull broadened out even more this time. I mean, it was pretty diverse, in December. When we look at current expectations, it's even broader. So you got to wonder who on the Fed doesn't think they're going to cut interest rates, for the next 2 years. So they obviously think there's zero chance of a recession, or that inflation stress is far greater. Now, so let's throw out the extremes, call it, these couple, certainly this one, and then the bottom one. So you take the middle. And so there's some consensus around where they're going to be, at the end of 2024, starting 2025. But really, there's more than a few up here, and there's more than a few down here. And while the median plot ticked up a little bit, obviously didn't move for the end of 2023. But it was pretty clear in the presser that Powell said we do not expect to cut rates this year, right? And so what's priced in? Well, again, when you look at the OIS curve, overnight interest rate swap curve, and you look at the Fed funds futures curve, there's a massive dislocation between what the Fed thinks they're going to do. Now, if we went back and looked at a couple of years ago and where they thought that they would be, now, night and day different. They were not expecting to raise rates or having to raise rates, and inflation was transitory, and everyone remembers that. So often the market is smarter than the Fed, and it's more of a leading indicator. But I think because of inflation and inflation pressures, unless you believe in deflation over inflation, that they actually aren't going to cut rates, and they only will on contagion and stress on capital markets. And to me, that's a lower low than what we saw last year, and possibly a considerably lower low. So in the 3,000, 3,200 range on the S&P, with the banks cratering, is that would move them significantly, whether inflation has come down enough or not, but not until then. So I don't think they're going to move on, bank stress alone, unless the capital markets follow. So with that idea in mind, let's have a look at the volatility measures of bonds and stocks. So this is the MOVE index. So it weights the 10-year more than the other parts of the curve, but it's 40% 10-year, 20% 2-year, 20% 5-year, 20% 30-year. So it's a weighted yield curve volatility measure centered around the 10. And you can see where we are now, up here at 170, and recently a spike towards 200. It's as bad as basically any other crisis we've ever seen, including the GFC, in terms of the uncertainty around interest rate outcome. But when we look at equities and we do that same comparison, we clearly don't see the same kind of concern. And so let's blow this up and look at, the 1-year view. And while vol ticked up for equities on this recent, sell-off, following the bankruptcy and insolvency of a couple of the banks, it really has not yet translated into the equity market. And I think we need to see that in order for the Fed to cut. So either the bond curve is wrong or equities have to get a whole lot worse. And I think that's the missing piece. So earnings season will matter as we get into April for sure. We're still about 3 weeks out from that starting. And then that's, mid-April through early to mid-May. And so, let's look at the charts here. So we came down, we held to a slightly higher low than what we had seen end of December. And so far in the year, the S&P's up a little bit, but the average stock is not doing as well as the headline. And we'll dig into that a little bit more. So I think that if this line breaks and we take out those lows that we just made, that we're going to go down and retest the lows that we saw last year at a very minimum. And it's going to be the Fed's reaction function, to me, that's going to dictate whether they move or not, in conjunction with the incoming inflation data. If that happens in the next month, there's no additional inflation data for them to move. So the bigger risk to the market is probably in the next few months than it is, 6 or 12 months down the road, if it takes a while to get there. But it's going to take a while for the unemployment rate to tick up and for us to officially get into that recession where once the unemployment rate starts to tick up over a quarterly basis, we know historically that means we are in it for sure. And that still has to play out. So there's a lot here in terms of the consumer's ability to spend and keep the economy going. Having said that, the Chicago National Fed Index that came out this week was very, very weak in its internal structure. It is clear to me we're ready to fall off a cliff, and it only is a matter of time. When we dig into the markets, so the S&P 500 as of Friday's close, 3967.24, up 3.3% year to date. And when you look at what's leading it, you can see the big FANG man names in general are at the top of the leaderboard. Some of the junkier type tech names are there. And I only need to slide this down a little bit to get Microsoft and Apple in there. So it's a handful of the big names that are leading the index when we look at it on an equal weight basis. So this view here is the equal weight ETFs. So the white line year to date is going to be the consumer discretionary index, but equal weighted so that names like Amazon, for example, and Tesla don't dominate the index. So the average stock in the consumers is doing a little bit worse than the market cap weighted. Obviously, equal weight tech, and we know, again, tech has been solid. It's been about the disinflationary story, about inflation coming down. Money is running to safety. And that's usually the first leg of it, where the riskier areas, okay, so financials and energy, the more cyclicals, the ones where there's the acute problems that we can identify now in the banks, again, really starting just a few weeks ago, falling off a cliff. I think it's only a matter of time before the rest of it breaks. When we look at the overall equal weight S&P yellow line. So we can see that on a year-to-date basis, the average stock in the S&P 500 is down, but the overall index is up, and it's masking what's happening under the surface. And that, to me, is more classic weak economy that is driving that. So bull and bear pick of the week, where do you go? Well, you look for a bullish longer term story that you like. Now, I don't love energy, but I think for the next few years, the disinvestment in supply generation and the potential for these companies to throw off tremendous free cash flows, even at oil at $70. But if the supply-demand relationship plays out like some of the bulls think, and we go back to 100, 120, not saying we will, I'm not making that forecast, but if we do that, the story is even more compelling. So when you look at the bull case here and you look at XLE, it starts to get attractive here relative to the last year. Now, about a year ago, not quite, I recognized this extreme move here in oil. Oil prices shot up to $120 a barrel, as we know, as the war was just starting. And I said, to me, that was the risk reward wasn't attractive. And I said, bearish. And frankly, for the next year, it's been flatter down. Mostly, there's been lots of trades to make there. We got positive in here. We got positive in here. So again, looking to get positive. Haven't done it yet in a big way, but nibbling, looking for the E&P type companies. So, an XOP ETF that focuses on the oil and gas exploration and production, starts to look very, very attractive, now. Question is on the timing. Is this the bottom, or do we need some economic fallout? If the markets are going to go down overall, oil stocks are going to go down too. So look for another notch down, start to nibble here. That's our bull pick of the week. Bear pick of the week is don't believe the market for a minute when you see these strong closes like we did on a Friday here and the VIX comes off. And, it's, to me, it's dumb money algo chasing news headlines where Yellen says something and they're doing some policy manipulations. The fundamentals here are that the economy is going to weaken. We are going into a recession. That is bad for equities. So have a great week, everybody. And let's just be a little bit cautious over here. It is not time to get bullish yet.